A major country is collapsing. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a major superpower is starting to collapse as we now have new data showing that its economy has officially entered a contraction. And what I want you to understand is this is going to bring down the entire world, because this country is so important in its region that all the countries around it are going to fall as it goes down. And we'll also have new information showing another superpower is massively decelerating. They're also heading into a recession. And I also want to show you why this is coming to America in the not too distant future. Let's over to CNBC, where we picked today's story up with a headline: German economy enters recession as first quarter GDP data is revised lower. The German economy entered a technical recession in the first quarter of this year as households tighten spending. Now, what I want you to understand in this story here is why Germany is so important, because they're the manufacturing hub of Europe. So when you see them go down, all those peripheral countries, well, they're going to slow down too, because of a manufacturing hub of the world, that does what Germany does goes down. It tells you you're going to have major amount of job losses, and it's going to ripple across the globe. So what we're seeing here, and I want you to see how the political elites are interpreting this, the policymakers are ignoring it. You're going to see that in a moment, but I want you to understand that their slowdown here, this contraction of their economy, while small in number, is serious in size. Data from the German Statistics Office on Thursday showed a downward revision of the GDP from 0 to minus 0.3% for the first 3 months of the year. This comes after Germany recorded a 0.5% contraction in the last quarter of 2022, now giving it 2 consecutive quarters of negative growth, which defines a technical recession. So we see the slowdown, we're now contracting, and then you're going to question is can the rest of the world be strong enough to pull Germany out of this? Or is Germany the first country we're going to see enter contraction, and then next thing you know, around the world, one domino falls after another, and we find ourselves in a globally synchronized recession? Germany did fall into recession at the end of last year, after all, as a shock in energy prices weighed on consumer spending. Again, something we're seeing all around the world, but they don't see a strong recovery there either. But they don't think that the German GDP will continue to fall in the coming quarters. I'm going to make the case why that is actually going to happen, but they do at the same point expect further weakness. So the question here is this the worst? Did Germany just trip over high energy prices, kind of fall on its face a little bit, and it's going to get up, dust itself off, and take off? Well, that's kind of the belief here. That's what everyone wants you to believe. But the reality is, if you look around the world and you start looking at where demand is, you're not seeing demand on the uptick where it's going to pull Germany out of a slump. What you're seeing is demand is starting to fall off virtually everywhere, giving this manufacturing hub of the world a major problem. And here we can see from the flash Germany PMIs, we had this earlier this last week, the German manufacturing PMI contracted at 42.9. Now remember, this was in April, it was at 44.5. It's sitting at a 36-month low. So to put this in context, when you see the manufacturing PMI at 45 or under, it tells you it's in a recession. We now have that validated. It continues to slow down. But notable, the experts were saying, yeah, we don't think that this is going to get any worse. And let me show you why they're thinking that in this next chart here. Because here's the manufacturing PMI, and what they're kind of suggesting is, hey, you know what? It's already pretty low. You have to go back to the global financial crisis, which, well, no one really believes is going to happen again. And hey, look, we had kind of what was looking like a double-dip recession coming out of that, but look, it recovered okay. And then we had a slowdown that kind of led to the pandemic, but look, even the slowdown rebounded. So the experts are saying here is, look, we don't think this can get worse, but the reality is it can get worse, and they're saying that GDP can't go lower. Well, let's take a look at some U.S. data. I want to compare kind of some of this factory data, these PMI type data that we're going to get from a regional Fed survey, and compare it to U.S. GDP. And we're going to look at why Germany is likely to contract again in the coming quarter. Here you can see the general diffusion index for Philly Philadelphia, using the current activity as our proxy for a PMI index, because again, we don't have the same data available on the Fred database, and we're going to compare this to the real GDP on a year-over-year rate of change. So you can see that what happens is as your general activity in the manufacturing sector goes down in blue, well, what happens, the red GDP goes down, and you start to see it contract below the green line and hang out there. Here you can see the manufacturing sector again in the 70s goes way down. You see it in the 80s. You see it in the 80s again. You see it in the 90s. And every time GDP tends to follow. But what they're kind of saying here out of the German data is, look, yeah, we got to a contraction, but it's going to rebound. What I want to suggest to you is that the contraction in their manufacturing sector is likely to get worse. Now, you would think that policymakers, the political elites would be all over this looking to say, hey, wait a minute, if this key country in the Eurozone goes down, not only the peripheral countries going down, but I'm going to show you how there's not one of their too far neighbors, another major superpower, is massively decelerating here, and this is going to cause problems all over the world. As Germany's recession is already forgotten, as ECB hawks circle. And here what they're suggesting now is the officials remain focused on raising interest rates in the Eurozone even further, because what they care about isn't the fact that Germany's in a recession. As we kind of have noted, what do policymakers want? They want to see people lose their jobs right now. You hear them say that, hey, you know, the labor market's too hot, which means, hey, if a few of you lose your job, we're completely okay with it because we want inflation to come down. The risk here, as we've talked about in modern economies, when you start the job loss train, when it leaves the station, you're going to get inflation down, but at the sacrifice of a minimally a recession. In this case, I believe a globally synchronized recession, with the U.S. also having a financial crisis from our banking system. What do you think? How do you think this plays out? Leave us some comments. I'd love to see. But here's the issue for the Eurozone, as this chart suggests, is, well, we don't care that Germany's slowing down. We got to keep tightening rates because inflation's got to come down. And boy, if they have a major recession there, they're not going to have an inflation problem for a whole lot longer. Surprising weakness in the Eurozone's biggest economy at the start of the year is a reminder that growth is fragile, which is pretty obvious, even before tighter monetary policy passes through in full, which suggests that they believe that monetary policy, this is something central bankers believe, it's going to hit with a lag. So if the lag is 3 months or 6 months or 12 months, and Germany's entering a recession now from all of these hikes, well, what's going to happen down the road? If those policymakers are correct and there is a lag, which unfortunately, none of them can seem to define with any sort of accuracy, well, what we know is that things in Germany are indeed going to get worse. For the ECB, though, the focus remains on underlying inflation. Don't care if you have a recession, as long as inflation comes down. Our forecasts show core inflation accelerating to the summer, keeping the ECB hiking till at least July. And now it turns over to China, as China warnings flash across global markets as growth disappoints. And now we're seeing data starting to be revised heavily lower here. And one thing that did give you a warning, we gave you this flash warning. We've been giving it to you for weeks. We've been telling you gold prices were going to come down. We showed you on our CTA report the machines were going down. This goes back to the Monday report. We see gold on the fast algorithms were minus 15% short and selling down to that level. We see the slow algorithms had dropped their longs down to 35% of their portfolio. And this report told you that triple top we've been talking about. I know many of you said, look, it's not going to, price is not going to pull back. The reports are showing it. If you had this tool, you'd have it every day. You'd know how to position your trades. Only $30 a month to know the answer of where the machines are. And when you hit these historical highs, like it tells you, that's time to lock in your gains. And that's what the report did. Recent data suggests gross domestic product growth this year will be closer to the government's target, about 5%. Now, contrary to expectations of a large overshoot formed earlier this year. The figures also show a lopsided rebound here in China that's being led by consumer services, while industrial activity lags far behind. So if you think about China, their normal growth rate is somewhere close to 8%, and that's kind of what their target is. So you say, well, wait a minute, how can 5% be a recession? Well, it can be if your growth rate is around 8. But notice another key point here. What did it say? Industrial production is down. What is Germany? An industrial hub. We know these are critical. So right now, the global economy is somehow going to be completely reliant on the services sector of the entire world to pull up the manufacturing sector. If indeed the manufacturing sector starts to lay off, it is game over. You're not going to find a bunch of people in the manufacturing sector go pick up, say, low-wage services jobs, and if they did, they're still not going to have the spending power they used to have, and that's why you see this all start to snowball, and eventually the services sector follows the manufacturing sector down. And speaking of down, you can get the link to the CTA-Timer Pro report down below in the description. In the crisis-ridden property market, sales are slowing after an initial rebound, combined with the persistent financial troubles of real estate developers, which we've covered many times in the past, that's hampering new projects in a sector which accounts for 20% of China's GDP after including related sectors. Infrastructure sector spending is being constrained by hefty debt loads of local governments, symbolized this week by 11th hour bond repayment by a state-owned firm. So again, what do we see signs of? Slowdown in real estate, too much debt. All these are problems, and all these are signs of what you see going into a recession, this time a global one. There was a lot of expectation that you see quite a strong year in China, as everyone was betting big on Chinese recovery to drive the world economy higher. And what we're seeing right now is a fairly weak China recovery in terms of industrial production. We haven't seen domestic consumption really come through, and exports, which is a huge issue, have been a problem, because when exports out of the world's biggest exporter, the #1 exporter, slow down, what does it tell you is going on with the global economy? It tells you everything you need to know, and that it is indeed slowing down. And there's further validation here right out of the commodity sector. Metals market faces grueling summer as Chinese demand falters, weakening construction activity to hit copper and iron ore. Again, great leading indicators out of the commodity sector here, as big conferences often crystallize the prevailing sentiment in markets. So it's probably no coincidence that copper has died below 8,000 a ton and iron ore is trading south of $100 after metals luminaries gathered in Hong Kong and Singapore to chew over the perilous state of global demand and China's recovery. Again, telling us everything we need to know is that we have Germany heading into recession, likely to go deeper. China slowing down, but at that rate could face a recession easily, particularly as exports slow down. We see the commodity sector validating this, and we're now getting a hint of demand problems. We keep seeing this in the US, and now Best Buy says, yeah, we see it too. It's Best Buy tops profit estimates despite ongoing sales slump. And Best Buy's steady outlook signals a ray of hope, however faint, after sales tumbled last year as consumers retreated from electronics and other discretionary goods that followed a binge during the early stages of the pandemic. Keep in mind, the binge was because of fiscal stimulus. Remember, we have no more fiscal stimulus. We now have high inflation. We know wages haven't kept up with it, and we know debt loads have gone up. Perfect recipe for a consumer discretionary-based company like Best Buy to see sales drop. And the retailer still has a long road to recovery as inflation forces shoppers to spend more on basic goods, making them think twice before buying televisions, computers, and appliances, which, as many of you know, people did during the pandemic. And now we take a look at the U.S. even further, because we've got the recent unemployment claims data. And hear this from Zero Hedge. Initial jobless claims rise after Massachusetts fraud revisions. And despite a confusing last week, printing 229,000, well below the 245,000 expected and the 242,000 prior. But they say it's big but Massachusetts, after admitting to widespread fraud, has revised its last 3 months jobless claims data lower by an average of 14,000 per week. The result is that claims actually rose last week from a revised lower 225 to 229,000. Now we're seeing again this increase in claims. It remains at pretty low levels, but there is one problem here. It's not that the initial claims pulled back. We know it's noisy. It doesn't always move in a straight line. Data does not do that. It oscillates. Its question is, where's the trend going? And for that, we're going to take a look at continued claims against the 4-week moving average of initial claims. So here in red is continued claims. This is people that are already on unemployment for a week or more and have not gotten a job. So what happens is when you see initial claims trending higher, but you don't see a material drop in continued claims, what it tells you is you're going to see more initial claims data at some point, because the two need to go together. If we start to see people come off of unemployment and get back in the job market, we would see these continued claims fall. We're not seeing that, suggesting, as everything we know is true, that the labor market here in the U.S. is about to come crumbling down at the worst possible time. But will the politicians get things done? Well, McCarthy says issues remain in the debt talks, all won't be happy, but they're looking to get it done. And here's one of the reasons why. And as amazing, as simple as it sounds, guess what? Politicians and their staffers, they all want to go home for Memorial Weekend too. And in order to do that, you've got to have something almost done and almost signed off on so you can come back from the weekend, button it all up, and get it signed off. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.